labor. But then if I add a little bit on, suddenly it's competitive with me making it in America only. All right, so next one. So let's talk about the tariffs and how they got calculated and what they meant to do to the economy. Next one. This is a timeline sort of since January, so a little bit after the election, of all of the major things actually that Trump has announced. And it's been pretty difficult to keep track of. I have a cool job. I get to go and talk to corporates about like how their businesses work. And most corporates are like, I can't keep up. It's like, it's Canada, it's China, it's Mexico, it's steel and aluminum. It's like, it's on, it's off, it's in court, it's been really difficult. So this is kind of an interesting chart just to see all the steps along the way. But this big spike here is the Liberation Day tariffs, right? Where the tariffs were kind of more consistently applied to a lot of different countries. And then we started to see things like deals getting done, climb down on Europe, and sort of where we are now, where we have a tariff rate that's about 17%, which is a big difference than 3% 6 months ago. So if we go to the next slide, what they did with the Liberation Day tariffs, which are the ones that really scared the stock market, was, remember, they're trying to fix the trade deficit. So they looked at who America trades a lot with. The bigger the country, the more trade America does with that country, right? The redder the country, the more trade deficit we have with that country. Okay, so you can kind of, if you're reading the papers, you're probably seeing Mexico and Canada in the paper. You're probably seeing Switzerland and Ireland in the paper. Definitely China. You got to talk about, like, you know, a lot of the Asian countries are oversized and very dark red. So a lot of the policies have been trying to target country by country where the deficits are. And that's why some of these countries have really high tariff rates in the announced deals or the announced proposals. So go to the next one. So this was what was announced back in April too. And I think one thing that surprised people was that every single country had a tariff rate, even countries that have a surplus with America. But if you remember, when Trump was campaigning, he talked about a 10% across the board tariff. Right? So this yellow box kind of does make sense. What should have surprised us more was this grey triangle. So what happened was, if we have a deficit with the country that's more than 20%, every additional percentage of deficit was a penalty rate of 1% on the tariff rate that was applied. And the circle size here is how much trade we do with that country. So you can kind of see a lot of the countries that America does a lot of trade with are also pretty high tariff rates, so 20 to 35, 40%, which is why the stock market's like, that's a big tariff rate. Going from 3 to 35, like, can we still have profitable companies with a 30% tariff on things that they need to bring in for the production process? So if we go forward one, where we are now, forward, is here. Well, that was last Friday. A couple of things have changed since then. But you can see a lot of the numbers have come down off the grey triangle. A lot of countries are more equal now than before. And that's important because you're not ending up with one country gaining another country. But still a lot of moving parts, still a lot of rates to remember. And generally some pretty high rates in there as well. So next one, let's talk about what the tariffs should do to the economy. And when you think through this like a company, I'll show you that this is actually what happened in 2018. The first thing tariffs are going to do is increase prices, right? That's kind of obvious. You buy something from another country, when it lands in America, the government says you owe me extra money, so your cost of bringing that thing in goes up. The second thing that usually happens is the governments that having their economy harmed by the higher prices, because higher prices mean you'll buy less of the stuff, right? So if you tax champagne in America, they'll buy less champagne. So France, which makes champagne, might be like, that's not fair. Tariff Kentucky bourbon. And so you get retaliatory tariffs. It's not real until the companies know both of these pretty well that they can start to think, do I change my supply chain, or do I absorb the tariff, or do I raise prices? Like, what's my reaction? And so I guess one good thing about last week when we kind of got to the end of the pause on the tariffs is we saw retaliatory tariffs. So we moved instantly from step one kind of back to step three, and now we can see what companies are going to do. And I'll show you a little bit what they're already doing. I think there's a risk that we get to step four at some point. if these tariffs do what they're kind of designed to do, right, and everybody tries to build factories in America, if they build factories in America all at once, I don't think we have enough construction crews to build the factories. I don't think we have enough engineers to fix the robots that are going to go in these factories. So there's going to be wage pressure on all these new jobs that we don't actually have right now, and we're going to have to train people to get into. So we can have actually more inflation from that than we get inflation from the increase in prices. We saw in COVID, when you have supply chain shocks, how inflation goes up. Okay, so next slide. This is a case study basically looking at 2018. Nice, easy case study. Trump put tariffs on China, and that was it. Right? China had gone from about 10% of America's imports to over 20%. In the 6 years that followed, you can see it's gone and basically halved. Okay, if you put prices up, it's harder for people to buy it, so they'll buy less. But what happens for companies is they're like, well, I still kind of want to sell things. I still want to make things. So you can see a lot of companies change their supply chains. There are some winners. All the countries around here benefited a lot. Mexico benefited, the green line, because it still had cheap labor. Actually, it was even closer to the US, although Mexico didn't have such sophisticated machining. So some of the more sophisticated things that were coming from China in terms of like machinery and finished tools ended up benefiting Europe. The point here is it will create supply chain changes and it will create winners as well as losers. So maybe you guys don't get as much negative press about this as I do in the States, but everyone's panicking that tariffs are all bad. There will be winners as well. Okay. And the stock market, which is much better at being forward-looking than all the data I've shown you so far, basically thinks the same thing. And the stock market says that actually Asia, which is red, and Europe, which is gold, might do really better out of this than the US. A little bit of an own goal, potentially. And so you can see, even with the sell-off that we saw with the Liberation Day tariffs, which were big in Asia, the outperformance of these markets still kind of persisted, and the recovery, it stayed that way. One of the theories is this is going to force countries to focus more on themselves. And by doing that, they might actually invest in positive things like their own industry, their own productivity, their own education systems, and they might make their own economies better to try and deal with this. Okay. So in terms of why the American economy, and actually this is OECD estimates of GDP growth for the year, who is most affected? The gray bar is the expected growth at the start of the year before tariffs happened. So the whole world was expected to avoid recession this year. What's interesting is the blue dots are where we are more recently, where the OECD thinks GDP is going to be more recently. And the biggest drawdowns are in the Americas. So tariffs are more likely to affect the Americas than this region, even though the tariff rates here are high, than Europe, even though there's a lot of trade with Europe. One of the reasons, if we go forward, is what you see in this chart. So this is the blue bars, the dark blue bars here are showing what proportion of the GDP of each country is exports to America. And it makes sense, right? If you're Mexico and Canada, you live right next door. So a lot of stuff you make would go into America. It can go back into America again, but a huge proportion of the GDP is things they sell to America. So if America makes them more expensive and the consumers decide to buy less from them, then they're going to have to go and find replace customers, or they're going to have to make less. And if you make less, your GDP falls, which is generally a recession because people lose jobs because the factories in Canada won't be making stuff because Americans won't be buying stuff. Almost all the other countries in the world trade much more with each other than with America. So there'll be definitely companies in Italy or companies in France that will suffer because of the tariffs, but the economy should be much more insulated from all the tariffs because they just don't have as much trade with America. Okay. If we want to think about this a little bit differently, so this chart here, the red is looking at what America buys, and the grey bar is what America sells, but looking at it by sort of product type. And so you can see we buy a lot of machinery that mostly comes from Europe. We buy pharmaceutical products, so that mostly comes from Europe as well. Asia tends to be the dominant counterparty with things like phones, electrical equipment, pretty much anything that we can plug in an American house, probably not made in America. and apparel. So apparel, furniture, shoes, clothing, all that stuff is a lot of that comes from Asia. If you're thinking about the exposure in the Americas, everyone's talking about cars. And a lot of the car companies make some of the products in America, but they make it in Canada and they make it in Mexico, so put it all together. So that's one of the things that the Americas is quite exposed on. If we go to the next slide, this is a different way again to look at it, but it kind of gives you, if you're an investor and you're trying to think like the companies that I own or the companies that I run, like how are they going to be affected by tariffs? You think about it this way, a services company, like tariffs are on goods. So services companies don't really have to pay much tariff, but they're still pay none. Like if if you've got a shareholding in a company that makes software, the people that work for the company still need computers to write the software, right? So the computer itself might come from a country with a really high tariff rate because it's an Asian country that makes electrics, right? And so it will have a small proportion of its products with a tariff rate. The flip side is you can think of something like the motor vehicles. We just talked about how cars don't get made in America. Pieces get made here, then they ship it to Canada and put it together, and then ship it to America and put a bit more together, and maybe it goes to Mexico before it comes back as an actual car. So there's a lot of components in a car that are not made in America, but generally the rate that you pay on the tariff part is a bit lower. You think about food, like groceries, a lot of groceries are actually made locally. So it's things like avocados and coffee in America, which we can't make ourselves, which we're going to have to import. And that again comes from a country with a moderate tariff rate. But you can think through, like, if you own American companies, do they have to pay many tariffs? Where do their products come from? Is that a high tariffed country? And what is their product? Like, is it something we need to import at all? Okay. So next slide. What does this mean for a CEO of a company? They have no idea. I mean, literally, they have no idea. This is showing CapEx expectations, and they've gone from wanting to build factories and hire people and grow their business to, I don't know what to do. It's just stalled spending, it's stalled hiring. Hopefully, now that we have a little bit of a resolution, remember those the 4 steps we have to go through. Getting to step 3 means now they do know what they have to do. They might have to move factories to America. They might have to switch how they source product. But now at least they can start to think about that. And that's kind of important from the economic growth perspective. Okay, so the second part, why a stock market's up. It's because you guys are buying, right? It's kind of interesting because when we got to the start of the year, this is using PEs, but basically the market was pretty well valued, but it was very well valued because interest rates were coming down, because inflation had come all the way back down to 2%, which was good for companies because they had less interest expense. You have earnings going up because people's wages have gone up, and so there was net gains in terms of real disposable income. So companies were selling well, margins were improving. Everything was meant to be really quite good this year, and unemployment was at pretty strong levels, so people's jobs were secure as well. Then we had the reciprocal day tariffs, okay, which freaked everybody out. You saw the 30, 40, 50% tariff rates. People are like, I wonder if we're going to like have heaps of inflation, because that's a lot to change on prices. And then it's like, I wonder if like countries retaliate and Trump does what he did with China, and the country puts tariffs up, so Trump goes higher and the country matches, and you kind of get the acceleration to the point where basically there will be no trade. If there's no trade, there's a lot of factories that aren't selling stuff. If they're not selling stuff, they're going to let people go. And so you have unemployment, you have a recession. So we hit this point here where people are kind of stressing out, like, are we going to have a recession? Is it real doom and gloom? And we saw the pauses, and we saw some of the deals coming through, and the deals, like we saw with the dot plot, were generally better than the original proposal, generally fairer than the original proposal, higher definitely than 6 months ago, but not as bad as they could have been. And so the market started to look back at earnings and say, companies will be okay. And so we kind of had the de-escalation back into this growth with a little bit of inflation. And maybe where we are now is, we probably are back almost in Goldilocks. And I'll show you why. So we go to the next slide. One of the things that's a truth, right, is that companies have a profit margin. They tend to make more revenue than their expenses. For a small and mid-cap company in America, it's been running about 7%. So assuming you're not importing everything that you sell on, you can probably afford to absorb some of the tariffs, right? And so people realize that profit margins might get squeezed, but it won't send companies broke. If it doesn't send companies broke, you probably won't have layoffs. So that's one factor that the market's like, actually, 7% margin, we can probably get by with some level of tariffs, which won't kill the economy. Let's go to the next slide. In terms of the tariffs themselves, they are actually getting paid. So you can see before Trump 2, after, and a lot of the increase is the blue color, which is the non-China bucket. So America is earning like $25 billion a month from tariffs. It's kind of doing what that first chart we looked at was saying would happen, but companies are definitely paying tariffs, right? So they're starting to already deal with the problem of the products being more expensive for them to make. So the next one. You can start to see some are passing that on as increased prices to consumers. Well, I should point at me because I'm the American consumer. You guys aren't. But this is showing the percentage of the products in each bucket that come from overseas, and this is showing their price rise. So you can see if it's more important, the prices are going up. It's kind of a one-to-one relationship if you look at that gray line. So there is definitely evidence that already we are starting to see companies raise prices. That's one way to deal with tariffs. The risk is we stop buying stuff because it gets expensive. The next slide is you can also reduce your margin. If we're buying stocks because we want to grow earnings, this is not great in the short term. But what's interesting is the companies that have seen their earnings decline are mostly sectors where they do import products, right? Consumer staples or consumer discretionary, materials, industrials, like they're all involved in stuff, products, which have tariffs in them. These sorts of information technology, communication sectors are mostly services, and they've been growing their earnings. So you can start to see some companies are definitely absorbing tariffs too. What we haven't seen is the economy really getting hurt. Like that was company data. So we go to the next one. These 6 charts are the 6 factors that the US government uses to determine whether we're in a recession. And one thing you notice is every single one of them's green, right? So we're definitely not in a recession now, but there's no evidence that anything's changed in the 6 months we've been waiting for some clarity on tariffs, right? You've still got GDP going up. You've still got non-farm jobs, so employment. It's slowing, but it's still going up. And actually, the slowing has been good for companies because in this period, wages were going up because there wasn't enough workers. Now, these companies kind of have a choice and can wait a bit for a worker, and the salaries don't have to go up to get the workers to work, which means personal income has been going up because salaries are going up, which means companies, well, personal income's leading to personal spending and then company sales. So you can kind of see this economy has actually been going pretty well. The only thing that doesn't look really strong is this industrial output, which guess what is related to manufacturing. But if we look at the economy in the next slide, so this is breaking down the services sector, which remember is 80% of the US economy in green. And so the services sector is positive. It's above the 50% expansion contraction line. And it has been, even as we've come out of the COVID highs, it's stayed positive. So most of the US economy, which services, is growing. The piece of the US economy that's been kind of looking like it's struggling a bit in the surveys is the red, which is manufacturing, which we're trying to fix for. But what's interesting is the gray is the industrial production. So even though it looked like in this chart it was kind of sideways, it's slightly positive. So the manufacturing sector has not been contracting in actual fact. And if we go to the next slide, the reason that's important, you can kind of see here, they're not ripping people off. So very few people in America know somebody who's kind of lost their job and that it worries them that they might be next, which is what happened in the credit crisis, right? A lot of people recently lost a job and then everybody stopped spending. And because of that, companies lost revenue. So they had to make somebody else lose their job and it kind of became a feedback loop. That hasn't happened yet. In fact, there's a couple of sectors that are still hiring pretty strongly, which means the consumer is confident that they have their job. They've had real wage growth, so the wages have gone up more than inflation, and they can keep buying stuff, which probably doesn't fix the tariff problem. Okay, so let's talk about the underlying economy. If you're a Fed bank, you're basically any central banker, you're doing the sorts of things to try and keep the economy full employment, right? And stable prices is the Fed's dual mandate. So this is looking at full employment, and the US unemployment rate at 4.2% is historically very low. If I go back to the 50s and like the 1950s, that's a really low unemployment rate. So lots of people still have their jobs. In Europe, that's a historically low unemployment rate because the European region hasn't been around for any longer than this. But basically, there's pretty good jobs and job security out there. So we tick that off, and then we go to the next slide. And we look at inflation, and the COVID spike of prices has basically gone back down to the 2% target that all the central bankers say they want, right? So the inflation problem's gone away as well. Tick. So if you're a central bank, we go to the next slide, it's okay to start cutting interest rates, right? You don't need them to be high to slow spending down to make deflation, because deflation's happened already. And all the countries, the major countries in the world, were cutting interest rates, which is good for companies because companies have debt and they have to pay interest. What's interesting in the US is because of the tariff war, because tariffs are definitely going to make things go, like prices go up for Americans, because the Americans are going to be basically buying things with tariffs on them. The Fed has stopped cutting rates, and so we have relatively high rates. That's helping hold the dollar up, ironically. But one thing that came out last week, the unemployment data is starting to look soft. Right? People are getting laid off, but people are also not getting hired because the capex, companies want to do anything. And so the market's like, well, we could be back talking about recession. So the interest rate curve here, even a couple of weeks ago, the expectation was for US to have high rates for longer, and now it's kind of dipping much more quickly, but still relatively high. Okay? But good for companies because companies will pay less interest that way. So yeah, let's talk about companies, right? Because you guys want to trade stocks. I like trading stocks. One of the things that's kind of a core in terms of stock valuations is the earnings, right? In theory, you buy the future revenues and profits of the company. So what this chart's showing in the blue is the stock market index price, and in the green is the earnings of the company or the companies in that basket. Right? And pretty close relationship, right? There's times where earnings fall and stock market falls less, but that's because the stock market looks forward through the end of the recession when things recover. But basically, you can see earnings are what you're buying if you're buying stock. So if we go to the next slide, one of the things that everybody thought would happen this year is companies will grow earnings really quite well. And for the most part, that's what we're still seeing. Right. So if you're owning stocks and you want earnings, you do want earnings to grow, and that was basically what's been happening. If we focus on the next slide, for the US small and mid cap companies, the interest rate story that we just talked about is important too, right? Because if you look at the small cap in particular, they were paying pretty close to 50% of their earnings before interest and tax, the EBIT, in interest, because the interest rates had got so high. So interest rates coming down, they were really looking forward to paying less interest and having more profit, being worth more. So the small cap should benefit from rates coming back down because they've never really had this much of their EBIT being chewed up by interest in the past. The next story, the US large cap complex has been growing earnings quite a lot better. And we got to the point this quarter, the expectation was what looks like lower, but American companies have this weird habit of, maybe my kids should do this, managing expectations and then over-delivering. Right? So what typically happens is when we get to the end of the season, this goes better and better and better because the companies actually surprise us positively. And the expectation is we will grow pretty close to how we have been growing. The tariff impact is only that little tiny grey box. So the tariff impact on profits, because it's 20% of the economy is goods and only half of that is imports, it's not as big as everybody fears, right? And then going forward, we're expecting earnings to actually grow and grow more strongly, okay? But what's driving earnings in those large cap stocks is not actually all the economics that we've just been talking about. If we look at the different earnings, so the red here is Asia, the black is Europe, and the green is the small cap US stocks. The earnings growth has been like okay, but not great, especially for US small cap stocks. Where earnings growth has been great is in the Nasdaq 100. I mean, the S&P 5 has done great too, but the Nasdaq's beaten it by a fair bit. And so we've got to think about what's in the S&P 500 and the Nasdaq 100 that's different, right? And the Nasdaq 100 has a lot of stocks that are tech stocks, right? So we go to the next slide. What we're seeing, if you actually go back one for a second, the dots on the very end there, which is earnings growth. If we go this side, the earnings growth of the dots, the performance, the stock price performance is the bars. So what we've been talking about like reinforces it. The performance of these indexes, the price performance has been kind of supported by earnings growth, relative earnings strength. Okay. Even Asia's had pretty decent earnings strength and price performance. Okay. So why is the Nasdaq 100 and the S&P 500 going so much better? It's AI spending. Right? Most of the revenue outperformance in those two indexes is coming from spending on AI, the hyperscalers, all the capex going into AI right now. And I think it's kind of a unique index. There's a couple of other ways to play the AI trend, but it is one of the things that makes America pretty popular with investors from all over the world because it's one of the better ways to play the AI theme. And all of these companies are NASDAQ listed, which is why the NASDAQ's beating the S&P, right? Because they're more concentrated in that index. Okay. Two more slides. And I want to sort of finish on a kind of interesting theoretical note, right? What is the point of AI? In theory, it should make us more productive, right? It should be like the internet. We had a productivity boom as everyone got the internet, got connectivity working, and things didn't need to be like physically delivered and handed across. You could just electronically match things together. Productivity growth is really important. If you look at some of the countries in Asia that have been investing in manufacturing and automation of factories and good education so that people can do higher value add jobs, like Korea, like Taiwan, they've grown their GDP really quickly. Taiwan's caught Europe up and past it. Even China, which probably started a bit later, is now running at a run rate that's really pretty strong. Compared to countries like Latin America, which just hasn't had any productivity gains at all, hasn't automated. And even Europe, where it's make it really hard to start a tech company because it's hard to fire people if you don't have profits and success, right? So being on this cutting edge of innovation, a lot of Asian countries are, is actually really important for growing the GDP of the whole country. And the reason that's important, if we go to the last slide, is when we started here, we were talking about debt to GDP, right? So one of the fixed debt to GDP is to have less spending and more tax revenues. That's the revenue side, right? What about if we just make GDP go up? All right. So what's interesting is this baseline forecast here is because GDP wasn't growing as fast as the interest expense and the net imbalance on the fiscal side. All we have to do to get to this green is grow productivity a half a point faster. In the tech boom, when all of the internet stocks started to work together, we grew GDP about 200 basis points for a decade faster. So AI, if it really is a productivity answer, could be really good for countries in the world where the demographics are pretty similar to America. The debt to GDP has been increasing. We can grow GDP because we make the countries more efficient, and we actually kind of get our debt to GDP problems under control, even though economies everywhere are kind of seeing an aging population. So kind of a hopeful, positive message. Oh, do you want me to take some questions? Do you want to read it to me?
So thank you everyone for staying with us until now. It's the first segment for the Q&A. It's the first segment. We'll actually open the questions to everyone on site here. If you've got any questions, please raise your hand regarding the macros Mr. Phil had went through. So anyone got any questions? Yes, the gentleman right here. So we'll actually open the question up to those joining us online. But first questions, yeah.
Hi, thank you for the presentation. It was very insightful. So I was thinking like with the there will be sharp increase in productivity, but that could also increase unemployment in some sense. So Productivity goes up, but less people are getting employed. So they absorb all the goods and services that are produced from the productivity boost.
Really good question. So there's a lot of different scenarios, and being more productive is one of them. It's possible AI is more like our mobile phones, right? So the internet made us productive for a decade. Our mobile phones and productivity data have not done anything, which is kind of surprising because it feels like a productivity enhancer when I can, get my grab and get my taxi to take me somewhere. But I guess in theory, I would have just waved a cab down and jumped in the same exact thing. All right. So one scenario is we were more productive. Let's hope that's true. The other thing that I didn't talk about much is the demographics of the world. And so the only continent in the world that's having enough babies to grow its population right now is Africa. Right? Even Asia, India is growing fast, but China's slowing down so much that as a region, you guys are shrinking too. So you almost might need to be more productive because you'll have less workers. Right? You've got less babies coming into the workforce and you've got people retiring as they get older. So it might end up being like a self-matching problem where AI can, yes, it replaces jobs, but it's like the people that are working. Anyway, the bigger problem, if you sort of really think about it, though, is there'll be some jobs that get replaced and not others. I know there's an interesting book that was written by the Vanguard economist recently where he talks about AI. It'll make some jobs more efficient. So you think about an investment advisor, well, these guys, right? You don't have to interview every single customer and then go research every single fund and do all the bureaucracy and admin because AI can probably do that for you. But you're the guy that can understand the stocks and why customers should be like this customer should be in a growth stock and this customer should be in a value stock, and you just allocate their money. So you're having a more interesting job because you don't have to do as much boring stuff because of AI. There'll be other jobs though, and maybe the taxi driver is an interesting example, right? Where that might disappear because we will be having self-driving cars. And so those people have to find different work. Maybe they'll have a bunch of factory jobs they can go into. I mean, this is the complicated part of massive systematic change. And so we don't really know how it's going to work out, do we? But that's because we don't really know how good AI will actually end up being. I mean, there's a lot of talk. So far in the data, there's no evidence of it really replacing people at all. Yeah.
All right, I hope that answers your question. All right, gentlemen. So, to the online questions slightly later. If anyone has questions on site, please let us know.
Thanks very much for the presentation. I wanted to ask your opinion. Showed that small caps were sort of lagging being large caps and little caps, especially the technology stocks in terms of earnings, also in terms of share price development. And I wanted to get your opinion. If you think that interest rates are going to go down, do you think that's going to fuel growth in the small caps, or is it going to keep continuing to fund money into the tech-heavy stocks like the large caps and especially Magnificent Seven?
Yeah, another good question. I mean, in theory, maybe it's two separate things, right? So the small cap companies are definitely paying high interest rates historically right now. So rates coming down will be better for their profitability, right? Because they already have revenues. It's just that most of the revenues are getting chewed up by their interest costs. So that should help them increase their margin. The separate question is if interest rates go down, to all of us borrow more money, have more of our own money to spend because our mortgages get cheaper or my mortgage gets cheaper because I'm in America, do I then put my money into growth stocks or do I put my money into small cap? And that's an interesting question. The AI theme, if that's what's driving revenues and it's meant to continue, I don't know how many years it's until it goes through the growth phase and starts to mature. But it's kind of a tempting investment, right? So maybe you end up allocating money into the AI theme and the growthy tech stocks for a bit longer, just because they do expect to have, especially the hyperscalers, right? There's a really interesting chart I saw the other day where basically the amount of data centers doing data center stuff will be stable. All the growth in data centers is to do AI compute, and it's going to go from less than the cloud compute data center to more than double the cloud compute data center space. So that's where the money's getting spent, right? Putting cloud compute, replacing cloud compute and putting it into AI scale investments. So it's probably two answers to your question, but hopefully good for both in a way. Yeah.
Okay, do have a lot of questions right here. So actually online, so you will be actually quite tight. So to
Hi. The valuations in the US market right now is also very heavily based on the tech companies and the expectation from AI and technology. With tariffs coming in, and as you said, currently what we are seeing is companies absorbing the tariff and not passing it on to consumers. Your earnings are going to come down, and the valuations are quite rich at this point of time. Uh, Whatever benefit we're going to see from AI and so on and so forth probably is not in the next 3 years or 4 years that Trump is going to be around. So, how do you see this play out in the next 2 to 3 years versus the longer term?
Yes, that's another good question. So, I mean, there's going to be a point, right, where the capex spending for people to build data centers to basically factor the AI models will kind of stop. Not stop, but it's not going to be the driver that it is right now. Then the second phase of AI, which might be the productivity phase, is all the companies that do normal stuff using AI to replace those workers, right? And so suddenly they can have half the workers make just as much stuff, and so their margins go up. I think the interesting for us as investors 5, 10 years from now is picking those companies. Right. And will some companies be really good at it and some companies really bad at it? Like they might have the exact same opportunity right now, but some management is a little bit more inclined to, test things and change things and experiment. And they might be the ones that get AI to be productivity enhancing for them, increase their margins, make them more profitable. So I think that's probably how things will work if we're going to get the productivity gains. Is widespread adoption across lots of companies of AI. So then you got to think about as an investor, like which companies can really benefit from AI? Like who do have probably process heavy, human process heavy, but I think relatively boring process is where AI will be able to replace people faster than a job where, you need a stock analyst who understands kind of how the market works and all the things you just talked about that are complexities in the dynamic to sort of do some judgment as well. AI might not be so good at that, but the driving of self-driving cars, like that might be real easy. It's the same every day, all the time. And that's where the productivity gains come from. So it'll be interesting when you sort of see it filter down. The other thing that I guess I would say, having lived through the tech bubble, that was when I was a mutual fund manager. There was a bunch of companies that were growing revenues, they had expected growth of revenues, but their cash burn was too high. Right. So potentially you sort of run into a point where someone needs to make money. The stock market back then looked at the maturation of the revenue spend in the tech sector, and that's pretty fully priced, like you just said. Maybe like this data has to be put on a pipe to get to us. Maybe the tech company, like the telecom companies, will do better. So that's where the tech and telecom indexes got formed. The telecom companies never made money out of the internet boom, right? Even though the data has exploded, they've gone from DSL, like dial-up and copper wires, to fiber, to microwave, to 4G, to 5G. But I think the reinvestment for them was so expensive that they never made profit doing it. So we got to think through this. It's going to be interesting as investors to pick the winners.
Well, thank you so much, Mr. Phil. And because we're really short on time, I'll actually take one last questions from online. But not to worry, for those on site, Mr. Phil will still be here with us. So once the session ends, and if you guys got time, do reach out to him. He'll be here. So the very last question is, considering that all the data that we have provided to the audience, what do you think about another coming tech bubble?
I mean, that's a different plausible scenario, isn't it? Where all this money is getting spent on this, like the model generation, and if the AI turns out to be like our phones and doesn't actually enhance productivity, the capex might never earn revenue. So that's totally plausible. I mean, you sort of think about it, as investing, like there's multiple probable scenarios. That's a possibility. The other possibility is the really happy ending where it makes us all really productive. A bunch of companies that you can deploy it, become more profitable, their margins get better, GDP goes up, we can all retire, do no work. It's a bit nirvana, but time will tell. That's why being an investor is kind of hard, actually.
Okay, thank you very much, Mr. Fu, and to the questions on the question online. So with that, actually, the next segment to Glenn is the Philips research manager. If you guys have any questions relating to the particular stocks, such as within the next 7, do let me know. Here with us today as well. So I'll have my time now over to Glenn, our research manager at Philips Security. Glenn, to you. So you'll be familiar with me. Seeing almost every Monday, join our working webinar. Yeah, so it's a very high bar for me to reach. So I'll just touching on the next 7 stocks and the outlook that we see for the sectors that we are in. Go back a bit, yeah, sorry. Just a usual disclaimer that everything is here for educational purposes. Do reach out to a financial advisor before you make any financial decision. Okay, sorry. Yeah, we'll move once to the start. Yeah, sorry. Yeah, so this is an interesting use of AI. I didn't Phil mention we use AI, so we are trying to use AI as much as we can. And this image here is actually generated by AI. You can try to guess what it's trying to represent. Basically, if you look at the it's all the tech companies, even the banks, right, on the trying to go on a run. But then Trump here, is chasing them and trying to pull the tail, but he can't seem to catch them, apparently, with what we've seen so far. Yeah. Moving on to the next slide. Yeah, next. Yeah, so the content today will be pretty simple, quite short. We'll just be looking at the sector teams. So I'll be covering all of the stocks in the next 7 of them. We'll do a quick conclusion and then we'll jump straight to Q&A. Yeah, first one. So I do cover Tesla. With other analysts covering the rest of the next 7 stocks. So Tesla is my specialty. So in auto, the main thing is whether or not the EVs can continue taking market share away from the traditional ICE companies. Yeah, so basically Tesla sales has disappointed, right? We are seeing the most recent quarter, I think in June, we saw that overall EV market fell by 6% year-on-year. But Tesla declined even faster, so they declined by more than double, around 12%. The reason for this is multiple. It can be coming from competition from other players. So this is a US market. I think they were fighting with other US makers. They have come up with EVs, and also the brand reputation with the CEO Elon Musk, and people just shifting away from Tesla. Yeah, moving on to the next slide. Yeah, so in China, it's even worse, right? BYD, which is the biggest in China, has continued to grow, right? And Tesla, they did pick up slightly in July, so the sales have still been very disappointing, right? Their competition is very stiff, not just BYD, but a whole bunch of other Chinese EV makers that none of us have ever heard of. It's very concern for Tesla in China. Firstly, the price is very high, and also they are not able to, offer more than what the Chinese EV makers are making. Now moving on to the next slide. Yeah, so the market share has continued to decline. We're seeing a slight uptick, right, in the second quarter of 2025 in the US, right? It was picked up slightly to around 46% market share. But in China, we can see, it's been on this continuous decline for the last almost 2 years. And that's it's very concerning for us as an analyst covering Tesla, because after they're still just a car maker. So if you don't sell cars, then it just shows that the revenue is declining, profit is declining. We do have a sell call on Tesla. Target price is $220. I think we are one of the handful of sell calls out there. Yeah. Now moving on to the next slide. Yeah, so what is really the light at the end of the tunnel for Tesla? The outlook for this year, it's basically, the CEO is returning back to Tesla, right? It's really very early to tell if this return can sort of turn the tide for the company. The
updated model Y we did a very subpar sort of reception. We saw the July figures, the second quarter figures, it didn't move much. So it just shows that people aren't receptive to this new model that came out. The third quarter will be another way where we can see if there is a turnaround in mobility figures. And I think last but not least, they also did release the robotaxi in Austin. So in Austin, Texas, we're very critical because that is what Elon Musk is really benching on, right? He's not really trying to shift away from traditional just a car maker. So now going into full self-driving and AI, and even this Optimus robot as well. But then again, the initial reports were quite negative, which is why we are very cautious on Tesla due to multiple headwinds. Firstly, the China competition, right? It's eating away market share in China, in Europe, in Asia, and also a lot of their initiatives are in the term to longer term, like 3 to 10 years out. So that's why we are very cautious on Tesla. Okay, now moving to the next one, we have the semicons. I think the main thing for semicons is that the higher AI is driving the growth for the semicon. I think the main company will be NVIDIA, of course. Yeah, so this just shows the combined capex of Meta, Microsoft, and Amazon. I think Phil did share this a bit earlier, but this shows that that is really driving the AI chip demand, and this is very beneficial for the main company, which is NVIDIA. You can see that in the second quarter, we're looking at it's up almost 65% year on year. And they spend the more it goes to NVIDIA. And not just NVIDIA, but of course, it will flow through to the other companies, the other chip makers as well, like AMD. Hopefully, some will go to Intel, but it's a bit hard to tell. Not moving to the next slide. Yeah, so we see a potential cycle in PC sales. So I'll just explain this chart a little bit here. Firstly, this shows the PC sales and at certain points, what has happened to cause it to either decline or to increase. Right, so we saw it here. Firstly, when the end of support for Windows XP, and then we saw a slight decline, and then the Windows 10. And then we saw like about 2 years or 1.5 to 2 years later, we saw this up cycle and tick in the volumes because people want to buy the Windows 10 computer. That's why they buy new computers. And then we saw a huge uptake in this due to COVID, right? Enterprises, consumers were all buying computers because of work from home. Then we saw this Windows 11 launch, and the same cycle is sort of repeating itself. And the end of support for Windows 10 will come somewhere around October. And if you take in that based on historical data, at least that 1.5 year to 2 years sort of recycling sort of change in uptick in the volumes, we'll probably see it coming around next year to mid of next year. And we also believe that the potential replacement for AI PCs will also play a huge factor in the demand, right? Because your computer is now obsolete. You need at least like 16 gig of RAM to run any form of AI application or anything, right? So this will force a lot of not just consumers like you and I, but more enterprises to change, because if they want to use the AI application to have to improve productivity, they will need to get a computer that can actually use that application, right? So that's where we'll see the demand coming in also from the enterprises. Yeah, so now for NVIDIA, we have an accumulated rating with a target price of $145. We are seeing there that their guidance has actually is for 50% year increase. So the impact from China, and they're still very optimistic, right? And, also recently, I think it's been announced. It's very hard to keep up with all those numbers and figures from whatever Trump is releasing. And the reversal of the chip ban, right? We believe that they can recognize the China revenue by the end of 2025, so end of this year. So that's where we'll see a huge sort of uptick. That will be a very big tailwind for NVIDIA. And last one, sorry, go back. Yeah. So it's not okay. Yeah, but another one will be the AI action plan that Trump has announced. That will also benefit, they're likely to benefit NVIDIA as well. Yep. Next. Yeah, next we go into the software and cloud. So we believe that the cloud growth has been quite steady. Yeah, the productivity is explain this a bit. So here. The blue line is productivity. So productivity segment represents Microsoft. And then the red line here is CRM. So CRM is customer relationship management software. So it's a bit like Salesforce. And the last but not least, ERP or enterprise resource planning is something like an vertical you're looking at. So we're seeing that productivity software has been outpacing the other two segments, right, and is expanding steadily. So we have seen sort of a moderation of growth in the second quarter, but it's still higher than what the other two are. Yeah, the public cloud is also searched on enterprise demand. So it's a bit a lot of enterprises, not so much, like consumers like you and I, but the enterprises are switching over to the cloud. So, you might be used to the usual SME, the small SME, just having all your data into a hard drive, right? That's maybe 10 years ago. That's what we were seeing. But now a lot of them are being, I wouldn't say forced, but they are moved away from that old school hard drive, store it somewhere in a data center, now moving into a cloud, because that's where we'll see the benefits of the cloud, when you can access it anywhere. And that's also a sign that we can work from anywhere, right? Not just in office. So we are seeing that really grow. The public cloud revenues is growing at a 17% CAGR, and this will be what will be benefiting the next slide, which is Microsoft. Yep. Sorry. We are still on the hyperscalers. Yeah. So the hyperscalers has profitability has outpaced revenue growth. We are seeing around 600 basis points margin increase in the last 2 years. Yeah. So now we're on to Microsoft. Yeah, we're seeing, as I mentioned earlier, the cloud growth. So it's not so much about selling their usual software, like you buy the Microsoft 360, you get the usual Microsoft computer. It's all about the Azure growth. So that's their cloud. Right? They're growing it and expanding it quite massively. The growth is sustained around 10 plus percent year on year. And also the AI contribution is accelerated around 17% growth year on year. So this is where we see, the AI impact. That is what we the CapEx spend that they have been putting to AI is now sort of showing some form of effectiveness by growing their cloud revenue and growing their contribution from AI. But then it is also a bit hard to tell whether or not there's any form of relation, because we're only looking at maybe a couple of quarters of data. But for now, we're just seeing that it's actually proving itself. Could we call Microsoft as well with a target price of $480? Next, we're looking at digital ads. So digital ads, we're looking at companies like Meta, Facebook, or Google, Alphabet. So we are seeing stronger monetization than peers, and despite the huge scale that Meta has, then we're seeing the other rivals that are there, or at least they are a lot smaller, right? They're seeing very little growth. It might be two things. Firstly, their scale allows them to just charge a higher price for their ads, and also, the positive thing is that even though they're so big, yet they can still charge such a high price, and customers, the people who are signing up for these ads, still have to pay. So it's a very positive sign. We're seeing the ARPU, or the average revenue per user, actually climb up steadily over the last 7 years, 5 to 7 years. So for Meta, the ad business has continued to pay off with the AI spending. We're trying to form a sort of a relationship here with AI spending and the ads business growing. So it will take long data to actually show this. Currently, what we are seeing is that whatever they're spending into AI is proving to be effective. Right? They're putting a lot of money into trying to understand the customer and provide better ads for the customer. In that sense, they just give more revenue, more profits for them. Right? And you can also attract scalability, they can attract more customers in, and it's just a cycle that goes on and on. So what we're seeing is that the margins have been on the same rise, like this orange line right here, and it's sort of correlated with the revenue, advertising revenue as well. I guess AI, at least the AI has a part to play in this. So the CapEx spend has come to some good news. Sorry, go back. We have an included com with a target price of $830 for Intel. So Google Cloud is also showing quite a bit of strength. We're onto Google now. Azure is, I guess, but Google is not too far behind as well. We are seeing that the revenue growth has been quite stable around 30% year-on-year. Yeah, next. Yeah, so for Alphabet, the cloud business has continued to show strong momentum. And we also believe that that's the reason why the operating margins have also improved, right? I mean, the last quarter when they released the results, it was really all about cutting the capex, sorry, the opex down, operating expenses down, and that's how they're improving their operating margins. Yeah, we do have a buy call, sorry. Yeah, buy call and target price of $235. Yeah, next, please. Yeah, so e-commerce, I think this is the one that will be hardest hit from the tariffs. Yeah, we just have a short sort of table here to show is the impact from the different e-commerce sectors as well as the companies from the trade war and the tariffs in general. Firstly, first-party retailers, like Amazon Basics, the impact level is pretty high, right? Because a lot of their products, if you look at the back, if you go and look around, you look at back, it's made in China, in Vietnam. So that's going to be a very high sort of impact level. Third-party marketplaces as well will be pretty impacted because they are like the middleman. And then if the demand slows down, then we'll also see the impact from there. I think it's a moderate sort of impact. But direct-to-consumer brands will also be very impacted, especially those upstart companies that think of a great idea, and move production into China or into Vietnam. And now they are suddenly hit by like a 30%, 40% kind of tariff. The drop shipping ones will be the worst hit, right? Like Temu, Shein, they sell directly into the US, right, from China, and we believe that the impact will be very severe. So that is the worst case for them. As for the digital-only e-commerce, like the SaaS companies like Shopify, we believe that will be pretty moderate. They will be as any affected. Yep, so like I mentioned, the goods that most affected will be the consumer electronics and of course the apparel. Yep. So the e-commerce dampening has not really kicked in yet, right? We're still seeing strong growth. I think it's because there's a lot of uncertainty, like what was mentioned earlier by Phil, where the companies are not sure of how much they should, increase prices or where should the cost go to, because we'll be sourced from many different countries. So we're still seeing quite strong growth. It's actually ticked up a bit. It might also be from a lot of people front loading, right? They're saying that we are going to face tariffs. So whatever I head back until Christmas, I might as well just buy it now. Right. So that's why we see this little bit of uptick. In the next few years, right, when it's more settled down, the cost finally could flow through to the customer. That's where we might see this a bit of a decline, or at least a decline in the growth of e-commerce sales. Yes. Yep. So for Amazon, we are really looking at the AWS. Their retail segment is the largest segment. It's with the tariffs that are ongoing and the uncertainty around it, and the margins being so slim as they are already, it's really hard to use that as a selling point. So we're looking at the AWS. That's really the Amazon Web Services is their cloud sector that is going to be the one that is growing revenue as well as growing the operating margin for Amazon. So we're seeing, when we look at the orange line, it's quite a good uptick, right? And so the margins are so much higher. Then if you look at the blue line, that's the retail operating margin. It's below 10%. And that when the tariffs finally flow through, we will see that this operating margin for the retail will actually decline. For the AWS operating margin, it still has come room to go, that it will hover around this just below 40%, and it will surpass that 30%. So we do have a buy call in Amazon with a target price of $2160. Yeah, so another sector that was very, I would say, in the news, right, because of the tariffs would be hardware. And the biggest name out there, of course, everyone's familiar with would be Apple. Yeah, so the smartphone, this shows very positive data, and I think the main reason for that is because a lot of, like what I said, a lot of front loading. People are buying, maybe they're buying, or they're just buying phones now when it's slightly cheaper and the prices haven't gone up yet. So we're seeing a huge rebound in the smartphone sales, and also if you look at Apple's most recent data and the results, the iPhone sales has actually shot up. And it's sort of to be expected because the prices haven't flowed through yet, and also the fact that a lot of people are buying in case of the tariffs. Yep. So we believe that there will be quite a bit of incoming margin compression with Apple. Although you have seen the recent news, of Tim Cook going to the White House and hand delivering this back to Donald Trump and saying that he's going to invest like 100 billion USD in America. Right? That could help to soften that a bit, right? And he's not going to put any tariffs on Apple phones. Then again, right, there will be a margin compression because not everything can be shifted immediately to the US. It will take time to build up all this infrastructure. It will take hours. It will take money as well. So the spending will hit their gross margin, and the revenue will also be compressed slightly when we see more figures come out. If prices flow through to the customer, if that will actually dampen the demand for the iPhone. We are quite cautious on Apple, so we have a neutral rating with a target price of $200. Yeah, so another factor for Apple and why we are also quite cautious is that the China smartphone market, they are legit losing market share in China. They're losing it to a lot of the homegrown Chinese brands, like you're looking at Huawei, Xiaomi, right? They are actually catching up a bit with Apple and they're taking away. The main thing is that we can sell a better product at a lower price, right? Which forces Apple to actually keep the prices in China, and that squeezes margins as well. Right? And so they are trying to play sort of like a price war with the Chinese makers. It's quite similar to Tesla in China, right? But they're also just trying to compete with the domestic makers, and it's pretty hard to do so. So yeah, reached my conclusion. So in conclusion, if we look at the earnings for the second quarter so far, the next seven has, I think every company except for Nvidia has released the results. It has beat expectations, I guess with the exception of Tesla, right? And the growth is pretty stable. AI is really still the new driver of revenue as well as margin growth. But we haven't seen a clear indicator of how they are monetizing this AI. We are seeing signs of it coming through. It hasn't been really clear whether or not the CapEx spend in AI has really driven revenue and profit growth. We are looking at this very strong recovery that we've seen so far in the second quarter. Yeah, we think that the companies will continue to deliver very strong results all the way until the end of the year, which is 2025. Yeah. So this is just all our counters that we cover. Yeah. So we do cover the banks as well, but yeah, we'll just be talking about the tech stocks today. You've been here for a while. Yep, so I only cover like four of them. And the rest of my colleagues at the end of this cover the rest. Yeah, okay, next. I think next slide. Yeah, next. I think it could all right, so this will actually be the Q&A segment. Thank you, Glenn, so much for the insight. And I hope this information will help you guys make a decision whether to buy or sell. And with that, actually open the questions to the floor right now. If anyone have any questions for the Mag 7 shares or any shares that we're curious. If not, I will actually choose some questions from online. If any. I do have a question online. This was regarding NVIDIA recent announcement on the revenue. How this will actually impact other tech government AI's chip sales in China. So basically, I think our summary is that it's basically the agreement of US and China, how will it impact the AI chips industry? Yeah, so you're definitely going to see, I think I mentioned it earlier, it was a bit of the short segment where I think it's a H20 chips, right? That would definitely benefit NVIDIA, right? They were previously banned from selling it and saying that, okay, you can sell it. So, but in the contribution, if you saw the chart earlier, it was like almost 0% to China because they were from selling it. But now that it's suddenly Trump saying that, oh yeah, no worries, you can sell it. There's, as long as you give a tax, right? I think it's a 15% tax, right? We can sell the chips to China, right? So from 0 to selling like 85%, let's say, right? It's definitely going to be a big upside for Nvidia. It's a big tailwind for Nvidia. I mean, of course, there's a tax rate, but if you look from where we started from 0 to like 85%, it's way better than 0. Yeah, I hope that answered the question.
Okay, any questions from on site? Anyone would like to? We got one. Just in the line. Hi, so much for the information. So based on the different stocks, it seems like there's not much upside if not some of the stocks reach the TP. And for Mr. So what's your recommendation? We're still on market. Yeah.
Yeah, so that's why we have the recommendation as well, because the recommendation sort of shows just let me clarify what the recommendation means, like when we say sell or accumulate, right? So basically, if it's neutral, means we are seeing a target price of -5 to +5, and then accumulate is +5 to +20, and then buy means our target price is 20% above the current share price, right? And of course, on the opposite side, where we let reduce and sell as well. Yeah, so we're looking at we're picking on selective stocks that we believe that is not overvalued, right? A lot of the stocks currently firstly, the fundamentals like Tesla, they're not really there. We believe that they're not there. Although, of course, people are speculating that it's going to be the next biggest AI company, right? And then we look at companies like Apple, right? The fundamentals are also a bit unsteady. That's why we have a neutral call. And then we're looking at companies like Nvidia, where we believe that there is some upside. Right, so you can look at our calls as well. Don't just focus on the target price, right? But what we recommend. So there's a strong buy, then there's a reason for that. Yeah. So hope that clarifies it. It's not just about the target price.
Okay, we are opening to any last questions on site. Anyone would like to give it a try? Any questions? If not, we will actually come to the end for this session. So before we wrap up, a big thank you to Glenn and Mr. Phil for their presentation. Can we get a round of applause to both of them? And thank you so much for everyone taking a time out. Just running through a quick for our site. We are actually having referral promotions right now. If you guys have any friends or family that you would like to introduce them to our platform, you can do a referral and it'll be about $600 that you can earn. And for them, what's in store for them is they have welcome promotions, which can go up to 2,200 in stocks or vouchers. So if you're interested, do reach out to us, if not our channel team right at the back, and consult them on what's in stock. So with that, thank you everyone. Mr. Phil will still be on site. If you guys have questions, do reach out to him. Thank you very much. Have a nice day.
Recording stopped.